Slack was the second biggest company as of late to go public via direct listing instead of the more traditional IPO. But what is a direct listing, and who makes it or what makes it different from an IPO? It is time for Yahoo U. Our own Professor Brian Cheung is here with this week's lesson.
All right, well, class is in session. As you will recall, Slack went public yesterday, but don't call it an IPO. What is the difference between a direct listing and an IPO? Well, let's start off with our example that we've used in the past. I am Cheung Shoes. I manufacture shoes. And big news, we are going public, folks. Who cares about all these other headlines about the Fed and Trump meeting with Canada? Cheung Shoes is going public. But we have two options to do that. The first is we can use an IPO or we can use a direct listing. So this is kind of in the simplest format, the best way to explain this. So if I decide to go with an IPO, Cheung Shoes is going to create new shares, and we're going to go on what we call the roadshow. So we'll go around the country, find investors that are interested in buying these new shares. Ultimately, what we end up doing is that we'll build a book of demand, find out who wants to buy these shares, and ultimately we'll sell them for money. On the day of the IPO, all of those new shares will be sold, which means that I've made a big raise on capital from all the money from that transaction. Then those shares will hit the public market on the New York Stock Exchange. Now, in a direct listing, it's completely different. Now, keep in mind that I already have existing investors. So Julie and Adam, for example, they've already invested in Cheung Shoes. They, in this case, in a direct listing, will take those existing shares and just put them on the market. And that means that at the New York Stock Exchange, those shares are not created, they're not new, they're just simply shares that previous investors have had that are now going public. So no capital raise in this situation. Now, why would we go with a direct listing? Well, there's two main reasons. The first is there's no stock dilution. So obviously, because we're not creating new stock, we're not diluting the value of the existing stock that exists out there. The second reason is there's no lockup. We need to illustrate the lockup a little bit further because it does get a little bit complicated. So let's create a new example again. We have Julie and Adam, who are both previous investors. Again, they were early investors in us before we were public, and they own shares of my company. If I went with a traditional IPO, Julie, you're in jail. You're not allowed to do anything with these shares. Sorry about that. But unfortunately, because of the fact that we've gone out on the roadshow, we've asked other investors to invest in these shares. What we don't want you doing is taking all the shares that you had from the get-go and then dumping them on the market to capitalize off of all those investors that we talked with to get those shares going public. But in a direct listing, the whole point of it is to get the insiders to put their shares on the market. So Adam, if you are if you were an investor of Cheung Shoes early, you could sell ahead of the IPO. You can go into the private markets and find a counterparty to transact with, or you can wait until the IPO day. You can sell it 10 minutes after we open. You can sell it at the open. You can agree to have the initial shares that are on the open. You could sell it tomorrow or 4 months from now. There are no restrictions. But Julie, there might be a contract that says you can't sell these shares within the first 6 weeks or 2 months after we go public. Now, the last point that I want to make here is that there is a distinct difference between the goals of an IPO and a direct listing. Again, I mentioned that there's dilution implications and lockup implications, but obviously with the IPO, as I mentioned earlier, you're raising money in that case. So you probably need the money for research and development to grow your company, what have you. But also, that comes with a cost. You need to pay underwriters to go on the roadshow and build that book of demand. So it does cost substantially more than a direct listing. In a direct listing, you're not raising money. Again, you're just taking the shares that are available privately and you're putting it on the public market. But this is cheaper to do. You still need to have underwriters because you still need to gauge the demand, right? You need to make sure that there are enough insiders that are willing to put their shares on the public market. But the cost of that is much cheaper to do.